Hi everyone, I'm Michael Henley, the CEO and founder of Brandy, Ware, Nook Private Wealth. I'm joined by our Chief Investment Officer, Peter Kim, and we're going to talk about what happened in the market this last quarter. So Peter, the markets have had a very strong year so far. Wall Street was completely wrong once again, predicting a major negative year this year. Help us understand what drove the markets this year and what indicators do we have this will continue?
Sure. So it's been a great year. So far, it's been a banner year for the markets, which I think is great to see. You would assume that tech has kind of continued to carry the load, and NVIDIA has certainly done extremely well. But what's nice to see is the breadth of market kind of expand.
Okay.
Right? So year to date, you'd assume be tech, you'd assume to be communication services kind of leading the way, but it's actually, financials, it's utilities, industrial is doing extremely well.
Really?
It's kind of boring is really doing well. So it's showing that everything is kind of growing with the market, which is very nice. And globally, we're seeing the same thing as well. Right? Everywhere else is cutting rates just like we did. China is doing extremely well right now because of the fiscal stimulus that they're putting out there. They're throwing everything, including the kitchen sink, at their problem.
Okay.
So I think that's going to be a very good tailwind to kind of help push everything along.
Interesting. So there's more than just NVIDIA doing well this year.
It's nice to see finally, right?
Okay. Yep. So it's not only in the US. I guess something clients will often ask is this rally only in the United States or is it globally as well? It's something that's globally as well.
Absolutely. So everywhere is starting to come out of a recession. Europe is coming out of one. The UK is coming out of one. China probably still floundering in it a little bit, but they are doing everything they can to get out of it at this point. So you're seeing everywhere now globally doing well. European markets are starting to expand. Australian markets are expanding. India is still continuing their run. China for the last week or so with the stimulus they're putting out there, that's now starting to turn a corner.
With the Fed cutting interest rates, Peter, will certain parts of the market do better, like small caps, for example?
Absolutely. They should at least, right? If history is any guide, when you have an interest rate cutting environment, typically what happens is those smaller, more nimble companies, all of a sudden they're getting a little more debt relief as well.
Okay.
They're able to react a little bit faster and kind of start to see them lift up a little more. And you're seeing that with small caps over the last few weeks, start to go and gain a little bit of steam and momentum.
Okay, so small caps are more highly levered, I guess. That's why they benefit from falling rates.
Exactly.
Okay, got it. What is the latest news from the Federal Reserve on interest rates? Do we expect another rate cut before year end?
So far, the Fed has said they're very data dependent. They've cut rates. They did 50 basis points, which I think was a little surprising for a lot of people. Kind of jumping right out the get-go and doing that. They have two more chances with normal meetings in November and December. So we get another 2 inflation readings at this point before that happens. So far, they said that if everything kind of continues along their plan, they'll probably do 2 more 25 basis point cuts. Whether or not that actually comes to fruition, you get only at 1. I think either way, that's still a good sign for the markets and the economy because they're not being forced to do this from a recession. They're doing it advantageously to help stabilize the markets and help continue to kind of help propel that whole market.
Got it. And typically the Fed's cutting rates because the nominal economy is getting stronger, right?
So now that, yes, the
okay.
economy is doing stronger. Inflation is very firmly entrenched going down. We may see a couple of little blips like a bouncing ball, but by and large going down.
Okay.
So if you have that, you can get back down to a more neutral rate for interest rates. And that's probably should be lower than where it is right now.
Have money market rates moved in tandem with the Fed cutting rates?
So you're starting to see them roll over and drop in rates. So the downside for savers right now is that with a declining interest rate environment, all of a sudden your money market rates and your saving rates are going to start to decline with that. And you're seeing that slowly kind of turn over at the banks.
Okay. So by having, longer term fixed income, longer term bonds, you've locked in these higher yields, I guess. You're still taking advantage. Is that fair to say?
That's exactly right. So part of the big benefit of having a longer term investment bond right now is that you get that higher rate for a longer period of time when a money market rate a year from now is paying significantly less.
Got it. Okay. So Peter, on a recent quarterly rebalance, what trades actually took place for clients?
Absolutely. So we try to be very minimal in terms of our impact with the rebalance this time. We wanted to continue with the markets, letting them grow and expand and drift all of our portfolios for our clients to be a little bit more stock heavy, which is what the end result was for us.
Okay.
Obviously, internally within the stock market exposure, we did rebalance that to maintain that general mix of global versus US exposure. But by and large, as the market expanded, we let the stock market expand with it. A nice thing for everyone right now.
Got it. Is everything pretty much at all-time highs? I understand gold's at all-time highs. Stocks seem to be at all-time highs. Crypto's close to all-time highs.
Pretty much everything right now is on a tear. That's a good thing to see it at this point. You want to continue to kind of lean into that skid because there's nothing really from a fundamental standpoint that's really giving us shaking news to get a little concerned.
In light of, Peter, the election coming up, it's obvious on everyone's mind, a lot of polarization going on. we expect market volatility to pick up in light of the election. Markets seem to hate uncertainty, right?
Absolutely. So uncertainty is very much kind of breeding some volatility in the markets. I think it's a hyper political season, obviously, with the election coming up, a month from now, basically. So I think you're going to see a little more white noise volatility. I don't know if there's going to be a huge impact in terms of market movement, one way or the other, in terms of sustained movement.
Okay.
But you could certainly see, depending on which way the wind is blowing, markets liking one thing and then not liking the next thing the next day, and seeing a little bit of white noise kind of shuffling.
It almost sounds like you're saying that hating the president is not an investment strategy.
Yeah, I would definitely say hating the president is probably not the best investment strategy, because no matter which side you're on for the last two presidencies, the markets went up after them. So.
Yep, got it. Okay. So Peter, we've been hearing about a recession. In 2022, the recession is coming. In 2023, the recession is coming. In 2024, the recession has to be coming. Is the recession coming next year, or is this still a bunch of white noise?
I mean, at some point, it's probably going to come, right? It's just a matter of when, not a question if. Markets go up and down. They have recessionary cycles where everything has to slow down and kind of take a breath. I think that's a natural part of the economy. And that's probably a good part of the economy as well, right? You want to have an ability to kind of retrench yourself, reestablish what actually is occurring in the economy, and kind of look at what the landscape is to make sure that the investments kind of line up with what the actual landscape is.
Guys, so the recessions are almost a necessary evil, if you will. You can't have an expansion without a recession, right?
Exactly. Think of it as like running a sprint, right? If you sprint out the get-go for a race, eventually you're going to have to slow down, kind of catch your breath. Same thing with the economy. If you're continuing to grow, you have to slow down at some point, catch your breath, get the lay of the land, and then you can start to run again.
Got it. At Brandy, we like to stress the 8 laws of investing. So the law we're going to talk about today is the 5th law, which this time is never different. A couple of times per decade, investors forget that recessions happen a couple of times per decade. So if the recession, Peter, happens next year, should we be running for the hills, or what should we be doing in our portfolios?
I think if the recession happens next year, we should be looking at that as an opportunity to take advantage of that situation. Because typically when you're having that occur, you're seeing the stock market take a plunge. The bond market typically does very well. That's a very good time to reassess and rebalance a portfolio, get it positioned in a way that can take advantage of when that eventual recovery will occur.
Got it. So basically looking at a recession almost as an opportunist rather than a victim, I guess is what we're saying.
It's a great way to think about this, because when a recession does occur, there's 2 ways you can look at it. You can say, oh no, everything's going down, or great, everything's going down. I can buy in at lower prices, lock in a long-term gain at this point, and take advantage of this rotation.
And recessions are really where you make your money long term. Even though in the moment it feels painful, it's really where you create your significant wealth long term.
That's absolutely. Taking advantage of those dips and using them to leverage your advantage is a huge deal.
And wasn't it Peter Lynch that famously said more money is lost kind of worrying about a correction than the correction itself?
Absolutely. If you're always preparing for it and thinking it's going to happen, then you're always sitting on the sideline and missing out on what could have been a generational wealth.
Thanks everyone for joining us. I really appreciate your time. If you have any specific questions, reach out to your relationship manager if we can help in any way.
Thank you.